Hello and welcome to Property Matters. I'm Stephen Galpin, and today we're going to be talking about pensions and property. And joining me to impart his specialist knowledge is Zee Razaq, MD of Surtax, who are property taxation specialists based in St Albans. Welcome to you, Zee.
Yes, thank you for inviting me on, Stephen. And I'm looking forward to this because, as I mentioned, this is an area that I really love because not many people understand it.
No, they don't. Me included, I have to say. So I'll try and keep my questions as pertinent as possible, but you'll have to bear with me. Okay. Well, look, what I'd like to do is start off. We're starting off going to talk about self-invested personal pensions and small self-administered schemes, which are SIPs and SSASs, I think, in your technical expression, aren't they?
You've done so well. I thought I had to explain what they meant.
Okay.
But no, that's fantastic.
Well, that's the first point. Perhaps you would like to explain the difference between the two and what exactly they're made up of.
No, it's fantastic because normally people think of pensions and it's like that thing that happens when you're 55, 57 or in your 60s, and they don't realise they are entrepreneurial tools. And we've chosen these two because there's a whole host of pensions, and I'm sure many pension advisors will be saying, oh, there's a lot, but these two are what are commonly used as the entrepreneurial tools. A SIP basically compared to a SSAS, and we're going to be predominantly focusing on a SSAS, but I wanted to do this comparison. A SIP is basically generally it's not a master trust because you're normally on the pension provider's master trust, whereas a SSAS, it is a master trust, i.e. it's your own pension.
Okay, so let me just clarify that. So one, you're administering yourself, and the other is administered by a set of professionals.
Absolutely.
Okay,
just to caveat that, when you've got a SSAS, it's a company, it's linked to your company.
Okay, right.
And another thing is normally you would have what we call a corporate trustee because the administration isn't straightforward around the trust to support you when you're doing a SSAS.
Okay, a bit like a legal advisor, if you like.
Absolutely.
Good. Okay, so we've clarified that. So I think the next obvious question from that is, which are suitable for who, I suppose? So in what circumstances would you have a SIP and what circumstance would you have a SSAS?
I think that the key bit is what you want to achieve. And this is where you should speak to your tax advisor who understands this area to give you the advice and how it does link into your overall objectives of what we call financial freedom. And this is one of the key tools to help achieve that. So if you want to grow your wealth and entrepreneurial aspects and be able to pass that legacy over to your children, one of the strongest ways is using a SSAS, as I've just explained why it's a master trust. And you'll probably say to me, see, what the hell is a master trust? If I'm allowed to say that. Answer your question.
Well, you tell me.
Yeah. The master trust basically means it is your trust that you set up and you have ultimate ownership of it. And what the key areas where you can differentiate compared to a SIP is when you, unfortunately, everyone's going to leave this world, I pass away, is how do you pass that money over to your beneficiaries, which are normally your children? Without
tax.
I love that part, yes. And there's two key parts, there's before 75 and after 75. So,
am I not right to think the law's changing on that or the regulations are changing?
Very good point, because as we're recording this, there is conversations around potentially changing this. Very good point. But right now we have to go by what it is currently now.
Yeah, sure.
And I just will say to the government, if they are watching and Rishi and the crew are understanding this.
I'm sure they're glued to the screen.
Love it. That they've got to really think carefully about this because it's not something that just a short grab for tax. It's a long-term impact because they're supposed to be making people invest into pensions for their future, not disincentivizing them. And I think the area that we're going to talk about is before 75, currently, if you pass away and you leave it to your beneficiaries, they get it without any income tax, which is massive. So they pass the legacy over. And the beauty is, within a SSAS, even if they're over 75, where you normally pay income tax, you can leave it in the SSAS and therefore protect.
It doesn't terminate at that age point.
Absolutely.
Got it. Okay.
And I think that's the big difference between a SSAS and a SIP, because a SIP, what will happen is when you get to unfortunately pass away, the pension provider wants to wind it up and get
Yeah,
finish it off
exactly.
because
Yeah,
it's
yeah.
it's a problem for them.
Yeah.
Whereas a SSAS, if you set it up properly, you are in
It runs
control.
infinitum.
It can run forever. That's the beauty of it.
Now, am I right in thinking, you know, we're having this conversation in the light of you being a property taxation expert specialising in property matters, okay? So we're really sort of subversively looking at these schemes as to how they could be beneficial to an entrepreneur in the property industry, okay? Now, am I right in thinking that either one or both of these, you can start to get your rental income and any benefits derived from that investment tax-free?
Absolutely. I think we've got to break that down and a bit
Okay.
unpack it, because the key bits of a pension are, and all pensions in this case, it protects you against 4 of the major taxes. Number 1, income tax, which we just mentioned.
Mm-hmm.
Number 2, corporation tax. Number 3, capital gains tax. And for me, the big one, inheritance tax.
Yeah. Can I just add something to that though?
Yeah.
Does it not also protect your estate from any insolvency difficulties?
Absolutely, depending how you structure it.
Mm.
So I think the example that you were talking about is if I buy a commercial property and I buy it within the pension and the company is renting it from my pension, you've split it.
Mm.
And therefore, in insolvency, the company may get liquidated, but the asset still stays in the pension and is protected.
Right.
Because it's a separate entity,
Yes.
it's a master trust.
I mean,
or
that,
trust and
you,
so
you
on.
know, property industry by nature is entrepreneurial and therefore has an amount of risk in it. And I would think somebody who's we'll come to the suitability of age entering these sort of schemes later, but I would think anybody always has to consider, oops, what if I make a mistake? What if I don't get it right? Can my pension be touched? And in these cases, I believe the answer is no, it can't.
Absolutely. Obviously, you have to caveat this, provided that you're doing like anything else,
You're doing it properly.
and within the spirit of the law.
Yeah,
because there is anti-avoidance, general anti-avoidance
Sure,
regulations where...
But that would apply to any normal commercial enterprise, wouldn't it?
Absolutely.
In other words, you've got to behave yourself and do things properly.
And get the right advice and get the right people involved.
Yeah, sure. Okay, well, let's just move on a little bit. So we've talked about the two key operations there, the SSASs and the SIPs. We've talked about some of the advantages that you can gain from that. What I want to talk about now is how would somebody walks into your office cold, how do you steer them one way or the other?
We normally deal with a lot of SSASs because SIPs are, as I said, tend to be with the pension operators, whereas SSASs are more entrepreneurial because they are linked to your company. Your company is a sponsored employer, and obviously one of the criteria is you have to be a director of that company to be able to use them. So if you want to grow your wealth, right, within the SSAS, i.e. the pension scheme, and outside it, we're going to go through some of these things, then for me, that is the option that you've got to really consider quite a lot, because you've got like $1,073,000 allowance in the SSAS. And you can actually get 11 people, so you can start thinking about within the SSAS. I would recommend probably very family that you're happy with.
How connected do those people have to be?
Really good point. Normally it's for directors of your company, right? So that's normally one of the criteria. But you can, provided your children reach 18, they can become involved and therefore be part of the SSAS.
Would they have to be shareholders as well as directors?
No.
Right, okay.
So there is a big difference there. The directors are key because it's linked to ultimately the individual and their allowances.
Okay, fine. And just for clarification, we ought to say that this SSAS is small self-administrative scheme. Is that right? I think?
Love it.
Yeah.
Steve, you're the expert. Get me out of a job straight away.
I'm getting good at this. Okay. All right. So, in general, you're giving advice to more people than not on the smaller self-administered schemes. And I suppose, what would it take a big developer to come in to want to look at the other?
I think you can get property investors and property developers. It's really depending on, and we give tax and cash flow advice, I want to clarify that. If you're actually doing an investment in the SSAS, we would get a financial advisor who understands the SSAS to be able to use it, because that's investment advice.
Well, I think it's very important, isn't it? I mean, we were talking off camera a little bit, and I was saying to you that I think it's always very important to make sure that you ask the right questions of your professional advisor, and make sure that your question is not taking him out of his comfort zone into another area of advice. And I think we should make it clear that your advice, you're creating tax efficient pensions, and that is your expertise. You're not necessarily going to want to advise on the worth or the credibility of the commercial asset you're buying. That's got to be a separate discipline with somebody else, hasn't it? Absolutely.
So you would have a couple of different things you mentioned there. One, if you're investing in stocks and shares, you would get a financial advisor, and we would suggest someone for that.
Yeah.
And if you're investing in commercial property, you would probably get a commercial surveyor valuation. That's a slightly different aspect, but actually whether it's tax efficient for you and does it meet your long-term strategy to receive achieve financial freedom, that's where we can help you.
Okay. Now, we've both mentioned commercial property several times within this conversation. And although the perception is that you can't really have residential property in a pension fund, you can, but there are certain penal taxations, aren't there, if you do? Isn't it at about 55% or something?
Well said. It's actually between 55 and 70 because they call it taxable property.
Yeah.
So residential property, a gold watch, just to use an example, or Rolex watch, I should say, or anything like this, they are considered taxable property, and there's a whole list. You can't have those in a pension.
What about if you take up a sort of REIT with residential property in, and then put that shareholding, or is it a shareholding you have in a REIT, or?
Correct.
Right. If you then move that into your pension, is that legitimate?
Yeah, and I think we covered that in a little bit of an early episode when we had another person who was quite an expert in that area. Yes, holding shares is legitimate provided they are not taxable property, and REIT has obviously exemptions. So there's a whole list of stuff that you can have.
Yeah.
I guess the bit that we probably want to look at for SSAS, specifically for SSAS, is something called a loan back.
Right.
And I think that's one of the biggest privileges a SSAS has. And that's how you can loan money from the SSAS up to 50% of its value to a limited company. And potentially, if structured correctly, you can buy residential property within the company.
Okay.
Right. So, and it has to be done properly. There's a few criteria that has to be put in place.
Okay.
But that way you can actually finance. You can also finance property developments as bridge finance. So you're becoming your own bank.
Even if that's residential property?
Correct, because ultimately what you're doing is a loan.
Yeah.
But you do need certain criteria to be met. So it's the actual residential property doesn't actually ever be owned by the pension, because that will trigger this nasty tax charge off. Yeah. And the other thing that is really quite important in this area, and it's quite big, is having the right security, because it is a pension. Yeah. So you have to meet the regulations of the pension.
Okay. All right. Well, that's all we've got time for in this half of the show. So join me again after the break. Hello and welcome back to part 2 of Property Matters. I'm Stephen Galpin and I'm sitting with Zee Razaq, our surtax property taxation specialist, who's advising us on pensions relating to property. Now, we've talked in the first half, Zee, about the different structures and the suitability for various types of people, and the difference between the two major schemes. In other words, one's self-administered and one is administered by professionals. What we didn't go into detail about was the ability, is it on both of these schemes, to be able to loan back the money in the pension fund?
I think we were touching slightly on it. No, you can't. With a SIP, and they're both professionally managed, just to let you know before I get loads of grief. Yes. It's slightly different who sort of runs the scheme. Yes. I think that's probably the big difference.
Well, let's just clarify that very point. That on the lesser scheme, you would still have a a sort of trust advisor, I think you'd probably call it.
Absolutely.
Yeah.
Call it corporate trustee, but yes, you have a tax advisor, and a lot of firms now provide both ends of that service.
Give you that service, right?
Yeah.
Okay. So, can you loan the money back?
Not with a SIP. So SIP does not allow you, but the SSAS does. The reason why the SSAS allows it, because it's linked to your company, which is the sponsored employer. So it can loan money to a company. But if you're connected, i.e. you're a director shareholder, it can't lend the whole 100%. So imagine you had $500,000 in the pension, it can only lend 50%,
Okay.
which is 250,000. The key benefits is, apart from obviously the cash flow benefits, because you become your own bank, is you have to charge interest. And that tends to be 1% above the base. There is technical, it's supposed to be the average rate of the top six banks, but let's say 1% of a base to make it easy. But that interest that you charge to your limited company, you save corporation tax on it.
Right.
And when you pay it to your SSAS, it goes in there, and SSAS doesn't pay no income tax or corporation tax.
Right.
So you're getting money to yourself tax-free.
So it's totally tax neutral then?
It's tax efficient, because in the corporation tax you're saving, so it's saving there. But when it's going into your pension, there's no tax.
Okay.
So it's actually tax beneficial.
Yeah.
And the other beauty is obviously you get the money. The thing you've got to be careful with this is a lot of people use it either to then buy more property, residential or non-residential, or even land. But people also got to be aware that that interest that you're charging is obviously a cost, an expense, but it has to be spread over 5 years as in the term of the pension. And that's the bit, it's not like a normal...
So the pension is administered in 5-year sectors, is it?
When you do the loan, the term of the loan is 5 years.
Okay.
There is some exceptions, but generally you've got to do it 5 years and then have the interest, well, the agreement, the interest is then charged annually, depending on your scheme. How you set
Well,
it
that should balance. If you've got to put 50% equity in anyway, that should balance out, shouldn't it?
Absolutely, but it's a huge way to be your own bank. And that's the big benefit. You're taking, that's why I call it entrepreneurial, because you're taking ownership of all your different pots of money.
Yeah, I see that. Okay, now the final part of the structure really is who can be involved in this. And again, I just want to come back to the suitability for different parties. Now, are we saying that the self-administered scheme is probably more suitable for the smaller developer and the investor, and the professionally managed trust is probably for the bigger developer or the bigger landowner, that sort of person?
The first part I agree. I think the second part we just need to tweak it. The SSAS, which we call, is suitable for nearly anybody, right? Provided they have the right information and it fits their long-term objectives. And
you're content that somebody else is administering the scheme?
Yes, because a lot of people won't know, just like your...
Well, it's going to be a cost to it, isn't it?
Absolutely, there is a cost. And normally we say to people ask, how much should I have in a pension to make it worthwhile? It really depends on how much you're going to get the value from it. But generally, I would say anything over 100,000, then it becomes beneficial to the cost of charges to service it.
Okay. Now, that's quite an interesting point that you raised there. You just mentioned the figure of 100,000. My next question to you is, at what point in their life does somebody start to structure these schemes? Now, it seems to me that if 100,000 is the sort of optimum figure for having a look at setting something up, I presume you're basing that figure on an assumption that there'll be a certain amount of fees, administration costs, setup costs, that kind of thing. So it's probably not going to be for the day one entrepreneur who hasn't yet built anything up.
Absolutely.
Is that right?
Absolutely. I think it's my view. Everyone will have a different view. Some people may set it up at lower. I did, but I understood what I was doing. But I'm sort of taking it as an average.
Yeah.
And the reason why is, it's not just the admin costs, is are you going to be able to fully utilize it? What can you actually do with the funds? So some people, what they do is they do a SIP initially, and I'm not going to mention name providers, but you can get them pretty much free in some aspects. Use it to build up funds and get the tax relief, because we haven't talked about how you get the funds into it.
Yeah, sure.
And I think that's a quite important part.
Yeah.
So, because you get tax relief in two different ways.
We'll come into that next.
Okay. So that's a really important point, and that's how you build the fund up.
Yeah.
And then it gets to a point where it's the optimum amount. I think from an age perspective, regarding pensions, whether it's a SIP or SAS, probably a SIP initially up to 100k you could do it from as quick as possible, because every year you get an allowance.
Yes.
And you get tax relief on that allowance. So I would start doing it now. So if you think about it, if I'm thinking I start in my 20s, I've got 40 years, if I contribute, say 25 grand every year, I will get to that end point.
Yeah.
Based on what the lifetime allowance is at the moment, the $1,073,000.
Yeah.
But if I start later, I'm going to have to put more in, and I may be restricted on how much I can put in depending on my circumstances.
Okay. The side question there is, in your first year of setting something up like this, let's say you're starting clean, you've gone to your advisor, somebody's coming to you and you say, right, I want you to start a pension and this is the way we're going to do it. Your kind of business, this is going to work for you. Is there a sort of exemption on limits for the first year's contribution to that pension, or is that restricted on the way through and just upped in increments as various budgets are provided to us?
Really good point. It's changed over the years. Currently, as we're recording this, the limit annual allowance is 40,000 per person.
Right.
That's a really good point. There is some exceptions, especially if I've had a pension before, like I was working and I had an employment pension, provided I've got a pension running, I can actually utilize 3 years before into the contribution. So if I've not,
so that could be 120,000,
160, because 40 in the year and the 3 years before.
Right, yeah.
And if I'm a husband and wife, I suddenly got 320. We love adding value. Think about the numbers.
Yeah.
So, and the company can contribute.
Yeah.
That's the difference, because when I'm doing it as an individual, it's restricted to my income. Whereas when I'm doing it as a company, provided I've got the resources within the company, I can do an employer contribution. So therefore save corporation tax on the way in. And also I'm not paying no personal tax. So just stack those numbers up. That can be quite considerable. They're called allocated contributions.
Okay, now the final point that we want to look at is who can be involved with you and how can you leverage the fund, I suppose would be the expression, would it not, or the accountant's expression, to make it bigger by utilising other people's allowances and having other people come into your SIP or your SAS?
There's two different ways, and we're predominantly the SAS because the SIP, generally most providers only let individuals.
Okay.
And I know some pension providers say you can do more, but generally when you look across the potential in the UK, most people only allow it to be an individual. SAS, because it's a company scheme, it can have up to 11 people involved in it. And that's therefore 11.8 million potential investment funds outside the 4 major taxes. But the key thing is, as you said, who can be involved in it. Normally it'd be, say, mum and dad, if they're running the company, if it's a family company, because that's what a lot of entrepreneurs have. And the children can be directly involved when they become 18, because they can then become directors and therefore have a pension.
And they don't have to be shareholders? No,
they have to be directors. So that's really useful planning. But one thing you've got to be aware of, and I'm going to caveat this, is unfortunately, unlike discretionary trust we've talked about in family investment companies, when you've got a master trust SAS, if you do get your children involved and unfortunately they marry the wrong person, and you have to know this, the wrong person can actually be entitled to their element of the pension.
Which I think the way the courts think at the moment, it used to be you start off and the lady used to have to justify getting in increments up to 50%. I think now it goes the other way. They start at 50% and you have to prove differently, I think.
I think that's a huge challenge. And generally, as Stephen's mentioned, it depends on who's in the more dominant position. So if it's your daughter, it could be their husband. If it's your son, it could be the wife. And generally, historically, has been the husband that's been earning more. But I know from having a few bosses who have been ladies, they earn a lot of money as well. So it depends who's financially in the stronger.
But building that potential up to 11.8 million is phenomenal, isn't it?
It's huge, and you can actually combine it. So what you could have is you and your family, and depending on trust, and I have to emphasize this, you could have another family that you're close to, whether it's siblings and their family, to get up to 11 people. But one of the key things is to get agreement at the beginning how you're going to manage it, because everyone's got a right to vote, and that's where it gets complicated. So,
but I mean, are you allowed to have, say, the principal having effectively a golden share?
No, it's not done like that. It's done by the individual. And I did have to look into that for that, but it doesn't work like that. It's one person, one vote.
Okay.
So you have to be, whoever's the trustees, they have, depending on the deed, they have rights. So you've got to be really careful who you get involved in your family SSAS.
Okay. Well, look, this is obviously amazing planning for any individual, and I think you're right. I think the people that actually do it are actually quite few and far between, aren't they, in real terms? But what I want to just finish up on, I'd just like to reiterate, where there is no income tax, corporation tax or capital gain tax on these schemes, it's so beneficial, isn't it, to your future? And the fact that it can, in certain circumstances, be passed on without being compulsorily wound up.
Yeah.
I mean, it's hugely advantageous, isn't it?
And that last point, inheritance tax, massive. And a lot of people are using this part of the family legacy, not only to build wealth within the SSAS, but also because of the loan back. And I know there's a huge amount of other stuff, depending on time, is what you can do to invest and use the money outside the SSAS.
Yeah.
And that is the difference. And that's why I said to people, you know, and I'll just talk about a few of them quickly because I know always time is a pressure. You can buy land within the SSAS because it's considered commercial, provided there's nothing being built on it. You can buy shares potentially in your own entity. You do need to do certain tests on that, whether it's got taxable property. You've got to be careful on that, but you can do that. It is restricted with a SSAS up to a certain amount. That tends to be you either higher off the 5% or lower off the 5% of your shares in the company or 20% of your fund. You need to look at that. You can also, as we talked about, buy commercial property, which is massive. You can actually borrow money. So if I've got a £500,000 fund, I can actually borrow up to 250,000. So I've got 750,000 pounds of buying power. And obviously as the rent gets paid in, it's tax free. You can use that with your limited company. So you can have your commercial property in the SSAS, charge yourself rent, save the corporation tax on the rent because it's an expense in your limited company. It goes in the SSAS tax free. The other thing that I just want to mention is people ask, and I've looked into this, you can buy gold bullion in there. Can you believe that? As long as it meets the criteria. A couple of points on that. It's 990 particles apparently out of 1,000 it has to meet to be gold bullion. And the other thing is you can't have the gold at home. You have to keep it. So there's places in London and places where they hold the, for SSASs, the gold. So this is a really important way to hold your wealth, retain the value of it, use it as an investment tool and pass it as legacy. So
with inflation running at the rate it is at the moment, let's just say for argument's sake 10%, are all these limits, you know, the 11 million, the 1 million, the 40,000 a year, are they all index linked or do they just automatically go up? Or?
Really good point, and this is probably the bugbear with a lot of people. It used to be a lot higher. And over the years, they've reduced it. And there's been even arguments to even reduce it more, but that's been silly. They should be. They went down to 1 million and they increased it to inflation to the 73,000, 1,073,100. It used to be unlimited at one time. And successive governments, and this goes back to what we said at the beginning, the governments have got to be really careful when they start attacking pensions because that is where our economy
the consequence of people not having enough money just falls back on the government, doesn't it?
Absolutely, and they should be incentivizing and maintaining these incentives because this is how people can protect their future. Because as we know, is the state pension satisfactory anymore?
Not really.
Yeah, and it may not even be there when I get there. So you've got to get the balance.
Well, I think you've got a bit of a long way, Zee. So there we are. Look, I'm going to say a big thank you to Zee Razaq for giving us all this information. I think you can see that these pension planning exercises can be really, really worthwhile for you. So do speak to your advisor and listen carefully to what Zee has to say about this because it's very, very important for your future. So Zee Razaq, MD of Certex, thank you for coming in. Great information, very helpful. Thank you so much. I'm Stephen Galpin. Look forward to seeing you next time on Property Matters.